Welcome to the Deep Dive, brought to you by Talk Tickers. Today we're tackling Enphase Energy's Q3 2025 earnings call. And this one was definitely a roller coaster.
Yeah, volatile is a good word for it. If you were watching the stock, whiplash is probably how you felt.
Absolutely. It was such a paradox, wasn't it? You had management delivering, really strong operational results for Q3, a big beat.
That's significant beat, yeah. Across revenue, EPS, operationally, things looked great. But then, almost in the same breath, they hit us with this surprisingly weak Q4 guidance.
And not just Q4, but that preliminary look into early 2026, forecasting a pretty steep drop.
Exactly. A major policy-driven trough, as they put it, coming in Q1 2026.
Right.
So the market sentiment just flipped instantly, right? Turned really cautious.
Right. It seems like the whole narrative got dominated not by the good quarter they just had, but by these deliberate, maybe even painful decisions they're making now about the future.
That's the core of it. So our mission today is really to unpack that paradox. Why did the market basically ignore the Q3 beat and focus entirely on the guidance and the tough road ahead?
Okay, let's do it. But first, let's acknowledge the Q3 beat, because, the numbers themselves were impressive.
They really were. Q3 revenue hit $410.4 million. That sailed past the consensus, which was hovering around, $370 million?
Yeah, a solid beat. And EPS looked great, too.
Crushed it. Non-GAAP EPS came in at 90 cents. The street was expecting something like 62 cents.
Mm-hmm.
Even GAAP EPS was decent at $1.50.
And operationally, strong volume supported those numbers.
Absolutely. They shipped a record 195 megawatt hours of batteries. That's huge. Shows attach rates are really climbing.
And microinverters.
Also strong. 1.77 million units shipped. So yeah, solid execution on volume.
Okay, so great numbers, but then the market reaction.
That's the kicker, right?
Yeah.
Despite all that good news, the stock just plummeted. It fell over 8% right after hours, and then the next day finished down, 15.2%?
Ouch. Yeah, that kind of drop doesn't happen without a reason. The market clearly saw something beyond the Q3 headlines.
Exactly. And that brings us to the financial details, the stuff under the hood that drove the skepticism. We have to start with the safe harbor effect.
Right, the big asterisk on that Q3 revenue number.
A huge asterisk. About $70.9 million of that $410 million revenue, that was safe harbor revenue. Basically, a one-time boost pulled forward from Q4.
Can you just quickly explain safe harbor for anyone maybe not familiar?
Sure. It's essentially when customers or partners rush to buy products before a policy changes or a tax credit expires, they lock in the current, more favorable rules. So Enphase saw this big pull forward of demand into Q3.
Which artificially inflated the Q3 number.
Exactly. And crucially, that $71 million tailwind just vanishes completely in Q4. It was borrowed demand, essentially.
So Q3's beat was kind of bought at Q4's expense. Okay, what about margins? Non-GAAP gross margin looked pretty strong at 49.2%.
It did, but even that had a catch. There was a significant drag baked in, about 4.9 percentage points, almost 5 points, because of reciprocal tariffs.
The tariff issue. Why is that hitting them so hard right now? Is it structural?
It is, for now. It's directly tied to their battery sourcing strategy. They're being proactive, shifting their supply chain for battery cells away from China.
To mitigate future tariff risks, I assume. And maybe long-term costs.
Precisely. But right now, that shift to non-China cell packs, it's just more expensive. That's the friction you're seeing, that 5-point drag on the margin line. It's an investment in supply chain resilience, but yeah, it costs them profit today.
Okay, so the safe harbor pull-in and the tariff drag already add context.
Yeah.
And that leads us straight into the Q4 guidance shock.
Yeah, the guidance was rough. Q4 revenue guided way down to a range of $310 million to $350 million. That's a sharp sequential drop.
And even if you back out that $71 million safe harbor effect, it's still a significant decline from the underlying Q3 run rate.
It is. And there's a second reason for the drop, which is maybe even more strategically interesting. Management is choosing to depress revenue further in Q4.
Choosing to? How?
They're actively reducing their shipments into the channel. They explicitly said they're undershipping the expected end customer demand, the sell-through, by about $45 million at the midpoint of their guidance.
Wait, hold on. Why would they purposefully undership? Isn't that just leaving sales on the table? Seems like a red flag.
It sounds counterintuitive, I know, but it's a calculated move. They want to normalize inventory in their distribution channels. Basically, clean out the excess stock before 2026 hits.
Like clearing out old inventory to make room for the new stuff.
Exactly. Think of it like that. They're prioritizing starting 2026 with a healthy channel, as they put it, even if it means taking a significant revenue hit in Q4. They believe this cleanup is crucial for the launch of their next-gen products.
Wow, that's a tough trade-off. A great Q3 headline sacrifice for channel health, leading to a stock plunge. Yeah, I assume the margin pressure continues in Q4 too.
Yes. The Q4 non-GAAP gross margin guidance reflects that. It drops to 42% to 45%, and they specifically called out that 5-point tariff impact continuing.
So no real margin relief until that non-China battery supply chain is fully ramped and maybe more cost-effective.
That seems to be the timeline. Yeah, early 2026 is what they're aiming for on that front.
Okay, let's shift gears to the regional picture. North America, specifically the U.S., seemed like the relative bright spot in Q3.
It definitely was. U.S. revenue jumped 29% quarter over quarter. That was driven partly by that safe harbor rush, but also by underlying demand strength, thanks to policy incentives.
What's the key advantage they have in the U.S. right now? Management highlighted something specific.
It's all about their domestic manufacturing footprint and the Inflation Reduction Act, the IRA. Because they're making microinverters in the U.S., they qualify for those 45X production tax credits.
And that flows through to customers.
It does. It allows them to offer IRA-linked benefits, like domestic content bonuses, especially helpful for installers using third-party ownership or TPO models. It gives them a cost and regulatory edge within the U.S. market.
Okay, so U.S. strong, but Europe. That was a different story entirely. Looked like it fell off a cliff.
It really did. A huge sequential decline, down 38% quarter over quarter. The policy environment there has just been brutal for them lately.
What were the main pressure points?
A few key areas. You've got soft demand in the Netherlands. That's a big market for them.
Okay, storage makes sense, especially in places like the Netherlands, right? If net metering is going away, batteries become much more valuable.
Exactly. They see a massive battery retrofit opportunity there. People who already have solar panels now need to add storage to manage their energy use and cost-effectively post-net metering. They estimate that retrofit market alone is a $2 billion opportunity just in the Netherlands.
Wow, okay. And VPPs, explain that a bit more. What's a virtual power plant?
So a VPP, a virtual power plant, it's basically a network of distributed energy resources. Think home batteries, EV chargers, smart thermostats, all connected and aggregated. Utilities can then partner with companies like Enphase to use this network for grid stability.
Ah, so homeowners get incentivized to let their battery help the grid.
Precisely. It provides another value stream for battery owners beyond just backup power. And management said they're already involved in over 53 VPP programs globally. It's a way to monetize storage differently, especially in markets facing policy headwinds for simple solar exports.
That ties neatly into their product focus then. Those record battery shipments in Q3 weren't an accident.
Not at all. It underscores that growing attach rate, and they're pushing their new fourth-generation IQ Battery 10C hard.
What's special about that one, besides being new?
Well, significantly, it's being built in the U.S., leveraging those IRA benefits we talked about. But for the homeowner and installer, the key benefits are technical. It offers 30% more energy density and takes up 62% less wall space compared to older models.
Less space, more power. That sounds like it simplifies installation and maybe brings down the total system cost.
That's the goal. Better density usually means lower balance of system costs, which is crucial for competitiveness.
Okay, so that's the product side. Now let's look at the big picture outlook. This is where management really seemed to pour cold water on things, especially with that Q1 2026 forecast.
Yeah, they didn't pull any punches there. They gave a preliminary non-binding outlook, basically forecasting a worst-case scenario. They projected revenue hitting a cycle trough around $250 million in Q1 2026.
$250 million. That's a massive drop from the recent levels. What's driving that specific forecast?
It's almost entirely pinned on the expiration of the main U.S. residential solar tax credit, the 25D ITC, at the end of 2025. That credit is driving a lot of the current demand, including that safe harbor rush. Its expiration is expected to create a demand air pocket, especially in Q1 26.
Okay, that sounds pretty bleak. But management still tried to sound optimistic, using the word constructive for the rest of 2026. What external factors do they think will help them climb out of that Q1 hole?
They pointed to three main things, sort of macro tailwinds. First, rising electricity prices in the U.S. They expect about a 5% increase this winter, which generally improves solar payback times.
Makes sense. Higher utility bills make solar more attractive.
Second, the expectation of declining interest rates eventually. That should ease the affordability crunch that's really hurt the solar loan market.
Lower financing costs are key. And the third,
new financing solutions entering the market. Specifically, they mentioned prepaid leases, or PPLs, being paired with loans. They seem to believe this PPL structure can effectively replicate the economics of the expiring 25D tax credit for homeowners, potentially reviving demand.
Interesting. So policy support might morph rather than disappear entirely. Now, beyond those external factors, they also have their own internal catalysts, right?
Yeah.
Pretty aggressive product roadmap for 2026.
Absolutely. This is where their recovery story really hinges, I think. The biggest move is their formal entry into the commercial solar market.
A new market for them.
A much bigger push, yeah. They estimate it's about a $400 million addressable market for their tech. They're launching the IQ9 commercial microinverter, designed for the 480-volt three-phase systems common in commercial buildings. And critically, it uses gallium nitride, or GaN technology.
Yeah, that's the next-gen semiconductor material, right? Smaller, faster, more efficient.
Exactly. It allows them to build powerful inverters in smaller packages, suitable for commercial scale. They expect to start shipping these IQ9 commercial units in December. That's a huge step towards revenue diversification.
Okay, commercial is one big catalyst. What about their core residential market?
That's catalyst number 2. The 5th-generation battery system. It's planned to launch alongside the residential version of the IQ9 microinverter, also using GaN. The whole point of this new combo is a step-change reduction in the total installed system cost.
How so?
The new battery is expected to be stackable, have even higher energy density than the 4th gen, and be much easier to install and service. If they can significantly lower the cost of the whole system micros plus battery, they can potentially regain market share, even if policy isn't as favorable.
Cost reduction is always king. Any other big product moves?
Yes. Leveraging that GaN tech again, they're making a bigger play in EV charging and vehicle-to-home, or V2H.
D2H, using the car battery to power the house.
Exactly. They're already ramping up their standard IQ EV chargers, but the big news is the planned launch of an 11-kilowatt GaN-based IQ bidirectional EV charger around mid-2026. This allows V2H backup power.
So the car becomes part of the home energy system.
Yeah.
That positions their whole product stack as a complete home resilience solution, potentially appealing even to people who don't have solar yet.
That seems to be the strategy, a complete energy management system.
All right, this feels like a good transition point. Let's move into our This Is Not Financial Advice segment. So the setup is pretty clear. We had a clean Q3 operational beat.
Immediately overshadowed by a very cautious Q4 guide and that really stark Q1 2026 trough forecast of $250 million revenue.
And the result? The stock got hammered. It's trading near its one-year lows, down, over 60% year over year?
Yeah, it's been brutalized. So the core thesis here for a potential trade idea is that the market has arguably fully priced in that Q1 2026 policy trough. The worst-case scenario seems baked into the current valuation.
Okay, so the bad news is known. What's the market potentially missing?
It might be underestimating the speed and, more importantly, the impact of that new product cycle hitting in the second half of 2026. We're talking the IQ9 GaN platform, both commercial and residential, and that cost-reduced 5th-gen battery.
The idea being that the new tech could drive a recovery faster or stronger than expected.
Potentially. The shift into commercial offers real diversification, and if the new residential stack genuinely lowers costs, that's a powerful driver. Plus, if they get that tariff drag under control with non-China sourcing, margins could snap back.
So given the really depressed stock price, the need for time for these products to launch and ramp, and the potential leverage if things turn around in late 2026, what's the outrageous but plausible trade idea?
Well, given how far the stock has fallen and the timeline involved, one aggressive idea could be to look at deep out-of-the-money LOP call options, maybe a spread structure expiring way out in January 2027.
January 2027, so buying over 2 years of time.
Exactly. It structures a long-term, highly leveraged bet specifically on that H2 2026 recovery narrative playing out. You're essentially betting that by then, the new financing solutions like PPLs help stabilize demand, and the GaN products gain real traction in both commercial and residential.
And the deep out-of-the-money aspect means you're maximizing leverage if the stock does recover significantly, say, above $50 or $60.
That's the idea. It's a way to play for a significant rebound driven by innovation, assuming the policy environment doesn't completely collapse and the company executes on its roadmap. You're buying time for the story to unfold.
Definitely a high conviction bet that product innovation ultimately wins out over the near-term policy and inventory headwinds.
That's the essence of it, yes.
Okay, so let's quickly recap the whole situation. Q3 looked great operationally, but it was boosted by that safe harbor pull-in.
Right, and the narrative now is completely dominated by the near-term pain. The strategic inventory destocking, hurting Q4 revenue, the ongoing tariff friction hitting margins.
All leading towards that forecasted Q1 2026 policy trough. The recovery path from there seems heavily dependent on these new products, IQ9, 5th-gen battery, V2H, and whether new financing models can effectively bridge the policy gap.
It's a lot riding on execution and market adoption in late 26. We'll definitely be watching closely.
Okay, before we wrap up, let's leave you, the listener, with a final provocative thought to chew on. Management made it clear they are laser-focused on shifting to non-China battery cell packs by early 2026. Their goal is to get rid of that reciprocal tariff drag.
That 5-point margin headwind.
Exactly. So here's the question. If, and it's an if, but if they successfully hit that early 2026 timeline for non-China cells, and they simultaneously launch that potentially much cheaper 5th-gen battery system, how much upside could we see almost immediately on the gross margin line?
Could they claw back that full 5 percentage points, or maybe even more if the new system is inherently cheaper?
Right. And if that happens, how quickly would the market re-rate the stock? Especially if it signals more durable, higher margins going forward. That potential margin inflection point is really the core of that 2027 LEP trade idea.
It absolutely is. The margin story is probably the single most important thing to watch over the next 18 months.
Food for thought. As always, please remember, this deep dive is for informational and educational purposes only. It is definitely not financial advice. Thanks for joining us today.
We'll catch you on the next one.